My name is Danny Jacker, and today I'll be giving you an overview that summarizes the likely impacts autonomous vehicles will have on the U.S. auto insurance industry, focusing primarily upon personal auto insurance. Autonomous vehicles pose many unanswered questions with major consequent implications for the industry. This video seeks to outline likely answers to each of those questions, namely, what will be the impact on the auto insurance industry, who will own auto liability, what new products and business models will emerge as a result of autonomous vehicles, and given all this, what are the key policy considerations? I'll now go through likely answers to each of those questions at a high level, and I'll spend the remainder of the presentation going through each of these in more depth. So to start, auto insurance market will likely drastically shrink in the long run as accident frequency decreases far more than increase in accident severity. Second, policy and liability will shift away from individuals and move towards OEM and fleet owners. Third, I think we'll see a host of new products emerge, ensuring these new types of risks, including those for hardware, software, increased threats for cybersecurity, and it will all be wrapped around various dynamic pricing models. And lastly, I think we'll start to see near-term benefits for insurance providers via short-term margin expansion as safety increases faster than premiums fall. So to give some context, what does the auto insurance market look like today in the United States? Well, last year it did about $230 billion in revenue, of which $25 billion was in profit. And it's important to note that actually personal auto insurance underwriting actually hasn't generated a profit in several years, but rather insurance companies make money from reinvesting the premiums. Given all that, though, it's projected to grow around 3% each year for the next 5 years, with the top four players really owning over 60%, so relatively concentrated. And those players are Allstate, Berkshire Hathaway, Progressive, and State Farm. I think it's interesting to note, though, that more than 90% of accidents today are caused by driver error, which actually gives us hope for a future where most of that can be driven away through automation. And you're already starting to see some of that today with some automated features such as front crash assist, which actually decreases accidents by about 15% for those who have that feature. To give a little more context, what do people pay for auto insurance today? Well, in the United States, it's about $1,200. And it's actually interesting. So those that are younger pay way more, then it dips down to when you're about middle age, and then once you're a senior citizen, it then increases again. So to make this even more tangible, let's look at what actual averages are for different age groups, assuming you haven't had an accident in the last 3 years. So if you're 19, that's about $2,100 a year. If you're 31, it's $830, and if you're 43, it's about $750. And it doesn't really get much cheaper than that before it starts going back up again. Average claim for a crash is around $3,300, and for bodily injury, it's about $17,000. I thought it was interesting that 6% of folks that actually have a collision claim each year, which was higher than I expected it to be, and bodily injury claims that happen less than 1%, which is probably a good thing, as it's showing most of these are more fender benders, or it's a testament to safety features getting better. So impact one, I think the overall insurance market will drastically shrink in the long run, and that's due to two features. One, as cars get safer and more automated, accident frequency will drop substantially. Many people think it will drop by as much as 80% by 2040. Also, the number of cars on the road and individual policies will also decrease, and that's largely due to two major trends. One, an increase in urbanization, and two is the increase in proliferation of the shared economy. That being said, driving the market up would be increase in claim severity as the cars have more technology in them. It becomes more costly to replace that technology. That being said, I think it nets out to a shrink. However, I think we'll see the secondary market, namely insuring hardware, software, and protecting against new types of litigation now that you have multiple different parties involved, will actually grow quite substantially. I think, though, that ultimately the policy and liability will shift away from individuals and towards OEMs and fleet owners, and ultimately the insurance market will bifurcate into two parts. One around machine warranties and repairs, and the other around liability around accidents and various other incidents. That's very similar to what you see today in the airline industry. I think we'll also start to see repairs and warranties shift away from independent mom and pop stores and do-it-yourselfers and towards OEMs. And that makes sense because the repairs would just be too complex for anyone besides the OEM to do, meaning that the OEM will likely be responsible both for warranties and for liabilities. And you're starting to see that so there's this quote here from the CEO of Volvo saying that, hey, if you have an autonomous vehicle, you better be prepared to take ownership of it. This actually poses an interesting question to the useful life of the car, because the useful life of the car now may end after the warranty. If technology advances very quickly, other third parties may not want to insure outdated technology, and thus, the car really kind of dies when the warranty dies with it. I think we'll also start to see new products being introduced around hardware, software, and cybersecurity that will really be more dynamic pricing and kind of pay-per-use. You're already starting to see early success with this from pay-per-mile insurance providers such as Metromile. And we may even see hybrid insurance where you only pay for the percentage of time where the human drives and not have to pay for the percentage of time that you're in autonomous mode. Pricing these new policies, though, is becoming increasingly data-dependent. On-demand policies are ultimately a race to the bottom, but you're starting to spring up. So companies like Slice actually offer data-driven on-demand prices for Uber and Lyft drivers. And controlling access to data really is going to be the source of competitive advantage. So if you have better data, you can price at a low price with margin and win. Whereas if you don't have data, you're either going to be overpriced or you're going to be underpriced. And if you're underpriced, you may win the business, but it'll have a negative expected value. That being said, in the short term, I think we'll see margin expansion from insurance providers because safety will get better faster than the resulting drop in premiums. So that being said, there are 5 main policy considerations I want to draw our attention to. One, I think we need to identify ways to speed up the approval process for new insurance products. Today, it takes more than a year, and if you're just copying, it takes several months still. And so as new technology gets out there, you're going to have to be faster than ever. And so it's really more prioritizing innovation versus bureaucracy. I think innovation wins here. The next one is having some type of common insurance policy standard or guidance across states. Today, every state has different policies, and so which makes it very hard for insurance products to scale. As you have these new products rolling out with new technology, scale is going to be increasingly important. So it's really more of a priority of, are you prioritizing innovation and efficiency or state rights? Next, I think it's going to be around privacy and ownership of driving data. Insurers need access to your data to give you better price policies, but again, do you really want to share all your data with others? And so I think the question is really around business need versus consumer privacy. Next is be around orchestrated rollouts that ensure customers understand product features. This is already an issue with backup cameras and sensors when people expect the car to beep, and when it doesn't, they actually hit things, which causes a lot of accidents today. You can imagine a similar situation where you expect your car to have some autonomous feature that it doesn't, and you get into a really bad accident. And lastly, most importantly, figuring out who's ultimately responsible for the owner of liability, whether it's the business, the owner, or the passenger. Time will tell, but it's going to really drive a lot of stuff in this industry. I want to give special thanks, though, to everyone who helped out. If you have any additional questions or comments, please reach out at djacker@stanford.edu. Thank you.